Shukla from Bajaj Finance, again with more than 25 years in financial services, recently elevated to the position of MD in Bajaj Finance, and Rahul Shukla of HDFC Bank, who's currently looking after commercial and rural banking, but is on sabbatical, very much in the mix still. We're given to understand between these three, Rajiv Anand and Anup Saha are the two names that the board is looking at more keenly. Informal discussions have already happened with RBI, but the formal names are yet to be submitted. We're also given to understand RBI may fast-track the approval given the urgency of the matter. As far as Jayaprakash Associates is concerned, we've reported there are 5 suitors.
Ritu, the bell is gone. The first tick is in the green, but it's a quiet opening. So after 4 days of a run-up, there is a pause in momentum. The Nifty is just up close to about 8 points. Sensex is moving between the red and the green line. Very, very quiet. But the mid-cap action continues. I think the mid-cap index is higher now for the 7th consecutive day with a gain of close to about 0.5%. The advanced decline ratio, the heat map, will also come up for you on your screen. So banks continue with their run-up. So a little bit of an outperformance, 100 points up on the Nifty Bank. It's Innocent Bank right on top, the stock that Ritu was talking about. Today is the last day for the board to submit names of the CEO to RBI. Innocent Bank is up. Jio Financials is having a good run. Axis Bank is gaining nearly about 0.5%. And in the PSU lot, it's State Bank of India in the green. Trend, Coal India, L&T, BHEL, Eternal, ONGC. These are a few of the large cap stocks where you have a bit of green going for themselves. On the way down, Reliance Industries, HDFC Bank, the big contributors to last week's up move, are retracing some of the gains. Not down a whole lot, just down about 1/3 of a percentage point, but those two heavyweights are seeing a little bit of a profit booking. Two-wheeler names like Hero MotoCorp are under pressure. SBI Life, Bharti Airtel, Tata Consumer are some of the names which where at least the first tick is in the red right now.
All right, from the broader markets, well, a few stocks are calling for attention. Transrail, that one, in fact, is buzzing away. Big up move is what we're seeing on solid volumes out there. So that one should come up for you on the screen. SBFC as well, that's another name that's doing very, very well. Solid uptake on that name as well. Volumes quite high on these two. Last few days, we have seen that Lloyd Engineering has been buzzing around and volumes are large. So that is up another 2% on large volumes yet again out there. So keep an eye out on that one. Jyoti CNC, as the bottom of your screen is telling you, there was a large trade that was executed and that was on expected lines. We had reported that as well. 1.37 crore shares, which is 6% equity. Changing hands, total deal worth around 1,500 crore rupees. Massive volumes. Let's see. Sometimes, once this deal gets out of the way, you see some of these stocks bounce back. So I'll be interested to see whether or not that's going to happen in this case. Hind Rectifiers, couple of big order wins. The street likes it. That one is zooming away. It's up close to around 10% as we speak. Last quarter's numbers were good. Couple of deal announcements coming in there as well, and volumes picking up on this particular name. Keep in mind, it had corrected, I think, from around 1,1700 rupees all the way to around 1,000 rupees, and that's bouncing back in trade. The Nifty, for the time being, well, that's a little bit lower, but plenty of stocks from the broader markets are doing well, and the broader market outperformance is something that's notable. Indra Prastha Medical, that's the other one that's up close to around 5%, massive volumes. Mangalam.
The pair of the morning has to be JB Chemical and Pharma as well as Torrent Pharma. So Torrent Pharma mildly in the green, opened much higher, opened about 3.5% higher. Thereafter is now sitting with a gain of just about 1.2%. Whereas on the other hand, we have JB Chemical and Pharma. The deal has been done at a discount to its prevailing price. Even the open offer is at a lower level versus its prevailing market price. And that stock, look at it, down 6.5% straight off the bat, lower in today's trading session so far. Bharti Hexacom did extremely well towards the close of trade on Friday, but thereafter the stock has opened slightly lower. Some bit of profit taking is what the street is seeing out there. ITD Cementation, one orders, the stock has been doing well lately and now opens fairly in the green once again. The other stock which is doing well is VRL Logistics. So the stock has been on an uptrend ever since it reported its fourth quarter numbers, and since then, volumes are piling up. The stock opens up with a gain of almost 4% with decent volumes. And another stock which is coming up on the volume gainers list is Dreamfolks. All of last 2 weeks it was under a wee bit of pressure, concerns around whether key clients are sticking around with them or not. Dreamfolks is making a bit of a comeback, but Torrent Pharma is the one that I'm watching out for once again, because now it's lost about 3.5% from its highs. Let's see whether the street, is okay with the balance sheet upsizing of this deal and the debt that it brings. Or in the near term, there would be some EPS-related issues. But other pharmaceutical companies are doing a lot better. So we have Aurobindo Pharma, which has moved higher. up around 3%. We have Alembic Pharma, which has moved higher, and Pfizer too has opened about 2% higher. So pharmaceutical stocks, barring Torrent Pharma, which is mildly in the green, are largely doing well. And JB Chemical, of course, because of the deal price being lower, is down about 6%.
And Karnataka Bank, a couple of big resignations at the top. The stock is selling off. It's down close to around 4.5% as we speak. So that's the other one you should keep on your radar. 4.5% or lower as well.
Schloss, Bangalore, the owner of Hotel Leela, and Aegis Vopak, their 30-day lock-in comes to an end. So Hormus was saying for Schloss Bangalore, the owner of Hotel Leela and Resorts, about 5% equity is now available for trading. The stock is down about 2.5%. And I think some other names also he was referring to. There was Synoris Pharma, Sai Life, Stanley. Some of these, in some of these counters, there is stock now available for sale after the lock-in has come to an end.
I wonder what's taking place with Godfrey Phillips. That stock has been smoking hot. In fact, over the last couple of months, it's seen a big rally right now as well. It's up around 3.5%. In this month, it's up around 10%. But we've seen in this year itself, the stock is up 80%. The first half of this year, it's up 80%. And it's not that it didn't do well in the previous year as well. So if you look at it, the second half of last year, it was up 50%. At another 80% in the first half of this year. So Godfrey Phillips is one of the stocks which is spiking as we speak.
All right, well, let's welcome Mahesh Patil, Chief Investment Officer, Aditya Birla Sun Life AMC, who joins in. Hi, Mahesh. Good morning. Good to see you win. Markets appear to have got its mojo back and in style. Now the street is talking about, higher highs and, in fact, moving on in the upward trajectory. What do you think? Euphoria? Or do you think that it's very realistic? I think earnings is going to be the key determinant, and we'll get a sense of that in the next couple of weeks. But how are you feeling with regard to the Indian markets as of now?
Yeah, good morning. I think some of the headwinds or the clouds which are lingering around, right, on the geopolitical side, as well as on the tariff front, I think those are kind of now moving away. And that is giving a comfort that, I think the risks which were there are kind of coming off. And you've seen that not only Indian markets, but even the global markets. I mean, US market is now almost close to its all-time peak now, right? Where, in fact, there's a bigger concern, right, in terms of slowdown in growth because of the tariff impacts. So I think that is, now kind of behind. And overall, I think the liquidity flow into the markets is also improving. We've seen FIs slowly starting to come back. Domestic flows have been steady. And I think valuations were reasonable. I mean, markets, after the correction, what we saw around 6-9 months back, a lot of stocks had come down to decent level. We've seen now interest coming back, not only into the frontline names. I mean, the large caps were always looking good on a valuation perspective, but even the broader market, right, the mid cap and small cap have seen a good recovery. Although I would say that it is more stock specific in the mid and small cap, not everything is moved up, but clearly, I think the confidence is coming back. And as we step into this fiscal year, we would see that the overall trajectory of growth, at least on the earnings front, should be better than what it was in the last fiscal year. More so in the, I think, second half, while the first quarter could still be a bit tepid because there has been some uncertainty on the global front. Companies have been doing a wait and watch. But I think clearly, with good monsoons also now coming in, we're expecting the sowing season has been good. So rural economy should do well this year, no? And that should support some amount of consumption also, which has been kind of lagging behind.
There's consumption which is likely to do well, sowing season, which implies that a lot of the domestic-facing names are likely to do a lot better. But, Mahesh, I wanted your views on the IT space, because that is one index which is still a fair distance away from its 52-week high at a time when all the other indices are fairly close to their highs. Do you think the weakness is priced in and global situation is looking a lot less cloudy now than what it was, say, same time last year?
I would guess so, yes. I think the IT sector was the first one to underperform, right, earlier because of global concerns. And I think on that front, I think US, where you were expecting a recession, the probability was much higher around, say, 3-4 months back. Now that has receded. And looks like at least the commentary also from the IT companies is that the worst seems to be behind. That doesn't mean that you will see a sharp recovery over there in terms of volume growth. It will be still slow and tepid. But I think this is a sector where I think overall stability I think would be there. I think the downgrade cycle seems to be behind over there. Also, the cross-currency impact also could be slightly positive, at least in this quarter, and that should support. So I would say that this sector is now looking, while the stocks are not cheap, especially in the mid-cap and the small-cap space in the IT is still expensive relative to the historical numbers. But I think clearly the headwinds there are behind. So I think if there is any positive surprise or slight change in the commentary, I think the stocks are probably ready to bounce from these levels.
So if you had to construct a portfolio, Mahesh, could you give us a broad sense of how you would do it with the preference and then the allocation to each of the sectors or themes?
So I think the allocation would be, preference would be more towards domestic plays because global uncertainty, I think on the tariff front, while we've seen that, I think that might still prevail for some time. So domestic plays, especially as I said, the focused on the rural consumption. So we've seen that even some of these agrochemical companies are likely to report very good numbers in this quarter because volume growth has been strong. But as we move forward, right, we should see some of the discretionary consumption, especially as we move into the festive season, should do well. Rate cuts have happened, and we've seen the transmission of that happening pretty fast, and that should help some of the interest rate plays, especially say if you're looking at banking and financial, then the financial services, and the NBFCs in particular, I think should see a better growth not only, but also improvement in the margins over there. So by and large, I would say a domestic focus, and on the external front, I would say sectors like say IT, for example, which have already underperformed and factoring a kind of, so I think they could be a kind of a contra play to look at.
All right, the big story really, Mahesh, which has given confidence, particularly on the macro front, has been the sharp fall in crude oil prices. And it's, continued. There's no big view that's come in that crude oil prices are going to dance away to 100 anytime soon, even though we have geopolitical issues that cropped up. In that sort of a backdrop, what's your take on these OMCs? They appeared that at least as of now, valuations are in favor, crude oil prices are lower. How would you play this fall in crude oil prices? Will it be the OMCs? Will it be the paint companies because they stand to benefit, or would it be the FMCG names?
Yes, you're right. I think even with the worst of the, tensions which were there, we saw the crude price didn't go above $80 or so, right? And now with those things behind, I think the pressure on crude oil is fairly evident. And it looks like it will remain at these levels, right, around $60 or so. So given that, I would agree that the oil PSUs, oil marketing companies, are likely to see a better kind of marketing margins. Although the refining margins have also actually improved a bit. So I think all in all, I think the outlook there should look better. But I think you should also look at, while crude oil prices have come down for the other sectors, it's also important to look at the demand side, okay, how that is shaping up, because unless the demand picks up, you will not see the benefit of crude price really coming in. Otherwise, they have to pass it on to the end consumers. So, but I think across the board, I think the inflation and this thing basket, I think should be lower. So I think that's good. And anyway, the macro, I think it is more important, right? Because we've seen that this last month, after many years, we've seen that the current account deficit, right, was in surplus. And that shows that it's a combination of not only crude oil prices, but also on the export side, remittances and this thing were also good. But I think that places India in a much more comfortable macro situation for stability. And that means good for flows, foreign flows into the economy.
All right, just look at Reliance. The stock has recovered a fair bit from the lows and actually taken the Nifty back into the green as well. It was mildly below the flat line at open for Reliance as well as the Nifty. And if you pull up both the intraday charts of the Nifty and Reliance, you would know that they're fairly strongly correlated right now. Reliance has been leading the gains on the frontline index. Right now, it's recovered from the lows, and that's taken the Nifty back into the green as well, slightly above the flat line. I wanted your thoughts in particular on the consumer discretionary space, Mahesh, because a lot of people believe that urban weakness is also now bottoming out, and from here on, discretionary would do a lot better than staples because, that's where a lot of the incremental income would be deployed. So in light of that, say hotels, Eternal, and a lot of these other new age companies, would you back them at these valuations?
Yeah, I think the discretionary consumption again was weak last year. It is recovering. Still, the trends are not really very strong. But I think the two things: one is the rate cut, which should start. The transmission should start through, and that will mean that your disposable income could be higher. Secondly, is the kind of a tax breaks which were given in the budget, right, for 1 lakh. Total amount which has been passed on to the taxpayers. I think that will start to now flow in, and that will help the rural urban consumption, I would guess. So I think, as I said, mostly I think you should see the impact of that coming in into the second half, where it should gather momentum. And rural consumption is, as I said, with good sowing season, rural wages are in positive territory. Real wages are doing well, slightly than what it was in the last 2 years. So that should also support. So I would say that consumption, especially discretionary consumption, retail companies, consumer durables, and the likes, I think could pick up. But it'll take time. It will not happen in the first half. I think you'll see that impact more in the second half.
What do you expect from banks in this earnings season? Because the latest reported system loan growth has been subdued. I think as of 13th of June, the loan growth was sub 10%, 9.6%, which is lower than the FY25 level. And plus, there will be the NIM compression that we will see on account of the rate cuts. So what's your expectation from banks? And if there is some weakness, would you go out there and add to any financial stocks? And where would your preference lie in financials?
Yeah, so banks this year, the outlook for overall growth is a bit muted in high single digits because, as I rightly said, because of the rate cut, you'll see an NIM compression. But I think there is some benefit coming in because of the overall CRR cut also. So the impact is not as high as one would have expected, considering that we have seen a 100 basis point rate cut, in the last 6 months, 9 months. Having said that, overall loan growth is, I think, the bigger challenge, as I rightly said, is in terms of the loan growth. In fact, last year, the concern was on the deposit side. Deposit growth was weak. I think that is now improving with overall system liquidity looking better. And banks have also been able to now cut rates, deposit rate much faster. So that should also help on the liability side, though the impact will take time to percolate through. So overall, I would say that the loan growth is the bigger this thing. I think and for that, I think we'll have to wait and see how the recovery happens, both on the retail side and even on the corporate side, because of the uncertainty. I think we've seen the corporates have been slightly hesitant in terms of pursuing with some of the capex plans. But as we get more clarity on the global front, I think you will see that also pick up. I would say that banks look good. Short term, this quarter, there could be slight, the profit growth would be slightly weaker, but I think one should really buy into this. We don't see any major structural challenge in the banking space. Continue to prefer the private banks. I think though PSU banks are also looking good now because we've seen them underperform recently and the valuations there are fairly comfortable. But again, they would be more cyclical play rather than structurally. We'll still prefer the private banks.
All right, we take that point. Thanks a lot, Mahesh, for joining in and chiming in with your view on the market, the economy, individual sectors, and how they're likely to perform from here on. Seems like maybe the second half of this year a lot better given the favorable macros. The one consensus view that is building on right now, however, is that oil marketing companies are likely to do better as their margins will improve. So let's take it straight to the management of Indian Oil Corporation. We do have A.S. Sani, who's the chairman of IOC, joining us now. Thanks a lot, Mr. Sani, for joining in. A lot that's been happening, right, in terms of tensions, and the first thing that gets impacted is crude and crude supplies. That seems to have eased so far, but despite that, could you tell us how much has India been importing from Iran? How has the volatility impacted the spread so far? How's your business likely to play out from here on?
First of all, there was practically no impact of crude supplies during this last 10-15 days that the war was there, war-like situation was there, we have not been affected. As India, I can say that we have not been affected, not only Indian oil. That is one point. The second point, you asked that how much we import from Iran. No, we don't import anything from Iran. As far as my information goes, most of the Iran supplies go to China only. That is the second question. The third question is the price volatility. Yes, it went up in a single day by around $10 to $11 to a barrel also. But the good news is that as soon as the situation seemed to normalize, it has again come back to sub 70 levels. It is 67, 68, 65 levels, which are a comfort zone for us as Indian Oil and as Indian refiners, Indian OMCs.
So what's the crude breakup looking like right now, sir? Say for the industry and for your company. What's the sourcing mix?
Actually, it is a dynamic thing. You all understand it. But the question that you are asking with reference to Middle East, around 40% of my crude are coming from Middle East sources, and balance 60% is coming from all other sources, including Russia, including Western African countries, including the Latin American countries, and other sources, maybe some of it from US and Canada also, and other sources. So it is a mixed batch. Today, India per se and Indian Oil is importing crude from at least 38 to 40 countries. So it is a very well spread layout wherein we are not depending, or we are not putting all our eggs in a single basket. So we have a pretty spread out.
All right, Mr. Saini, if you could tell us what are the current petrol and diesel cracks? And if you compare it, say, with 3 months ago or 6 months ago, has there been a big swing out there?
Volatility, yes, of course. When these disturbing situations were there, it affected the gas oil, that is the diesel cracks more, because a lot of gas oil comes out of Middle East and it goes into other geographies. So there was a concern on gas oil availability for other parts of the world, not for India, but for other parts of the world. So it affected in a slight jump in the gas oil cracks. Gasoline cracks, the MS cracks, were more or less went unaffected, and they are the same as they were, like more or less in the same range as they were maybe 3 months back, or maybe say before war. So we can talk of before war and after war. Gas oil, yes, it jumped. Now it is getting somewhat subsided, but not totally where they were before the war. But gas oil, but the gasoline MS is more or less intact.
Right. I understand that qualitatively, sir, but if you could give us some numbers on that. What would the number of those cracks be? What levels are they at?
Around $7 to $8 for gasoline, and around $12, $13 for gas oil.
Okay. Sir, everyone's been talking about the new green energy push. What kind of capex from Indian Oil will go into green energy?
Capex, it is a long-term strategy that we have. We have a very laid out strategic plan going forward up to 2046, wherein we have an ambition of becoming net zero in our scope 1 and scope 2 emissions. And this plan of next 20 years, it has a layout of at least 3 lakh crores total investments. This 3 lakh crores investment is spread out over the next 15-20 years, which will go into the green energy initiatives. But at the same time, I would like to mention that all these investments that we are going to place in action in next 15-20 years will be based on the returns, because we see green energy, or we see the drive towards net zero as an initiative for increasing the profitability. It is not that we are just going to spend money. We are not going to spend money without the returns, because when we go for renewables, it gives me good returns. We expect to give good returns. Then we are going for green hydrogen. We expect that ecosystem will be developed, and then we will earn money out of it. Similarly, when we go into biogas or bioethanol or those things, we invest money into it with solid returns expectation.
Well, sir, you have a lot of expansions coming up, all across the country. Panipat, you have in Gujarat as well. Where do you expect, the one to come through as well, the Baruni? If you could give us some details with regard to your expansions.
My expansions are going to come on stream mostly towards the end of this financial year, maybe December 25 or by March 26. Most of them will be in very advanced stages of commissioning during this time period. That is one point taken care, and that will increase my refining capacities by around 20%, where I stand at around 80 million tons along with my subsidiary, that is CPCL. That will go to almost 100 million tons per annum capacity. So that is one thing. The other thing that you about the battery, in battery we are, first of all, we are in the value chain wherein it comes for EV charging stations. So we have, at least Indian Oil has around 14,000 EV charging stations spread all across the length and breadth of the country. That is one part of it. The second part is we are into battery swapping business. The battery swapping business, it comes in a JV with Sun Mobility. It is by the name of Indofast, and this in 3 or 4 geographies in India, around 1,000 battery swapping stations are already operational, and they are doing good business. They are. This is the play where we want to focus more at this point of time. Battery manufacturing, we are in talks with people. We are in talks for technology transfer with people. If that happens, we might go into the battery manufacturing area also.
Sani, the one long-standing issue that's been the LPG compensation with the government. Have you been in talks with the government for any sort of under-recoveries that we saw in FY25 for LPG?
Yes, we are in very positive talks. We have been given to understand that a big portion of it might come to us, and we are pretty confident of amply and adequately compensated for whatever is due for us.
Could you give us a sense of what timeline could this be and what the quantum of this could be?
No, timelines I can't assure, and I can't assure about the quantum also, but I've been given that they are considering our demands, and they are very much aware that it is all linked with what capex I have to do, how I am growing in my businesses, how I have to invest more and more into greener solutions and sustainable energy sources. So the capex is needed to be done. So that criteria is there in everybody's decision-making matrix.
All right, so one final question before we let you go. Give us an update on the refinery with CPCL, the Nagapattinam refinery. Will that also come up and give you that 100 million metric ton target that you have spoken about in the past?
The Nagapattinam refinery is, we have gone back on the drawing board because the viability of that refinery was not becoming very good. So now we have gone back on the drawing board and we are putting into more and more petrochemicals into it. So it might change the financial outlay, but it will be more of a petrochemical plant now going forward instead of a pure refinery play. So we are reconsidering our configuration, and again we will go back to our board for taking approval for that and then move forward.
All right, in that case, that will be an important one to track going forward when it comes to Nagapattinam. But more importantly, we'll watch out for, your cracks as well as margins going forward, along with volumes. And if at all there is any sort of recoveries coming in from the LPG under recoveries from the government, at what time, what quantum. Thank you so much, sir, for joining in and giving us your view on the company and the industry going forward. With that, we'll take a short break. But just before we do that, pull up the intraday chart of Alembic Pharma. It's been a big move out there, up around 10%. In fact, it's currently the top gainer in the broader markets with decent volumes as well. So we'll keep an eye out on why that one's moving. And the other one is Kalyan Jewellers. Remember on Friday, we did have Gautam Dugar join in from, Motilal Oswal did say that if gold prices stay stable, then it would benefit some of these jewellers in terms of demand over the next few years if gold stays stable for the next couple of years as well. And Kalyan Jewellers along with Titan stand to benefit. With that, we'll take a short break. On the other side, markets, the investment scenario with William Sells of HSBC joining in to talk about that and the global trade uncertainty.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by Century Ply Club Prime, Raho Befikar.
AIM to transcend growth effortlessly. Wonder which market cap to invest in. These funds aim to blend asset classes for growth. Motilal Oswal Large and Mid Cap Fund invests in select large and mid cap stocks with minimum 35% allocation. Motilal Oswal Multi Cap Fund invests in select large, mid and small cap stocks with minimum 25% allocation. Motilal Oswal Flexi Cap Fund invests in select large, mid and small cap stocks without restriction. Think equity, think Motilal Oswal. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, 7 दशक देश के साथ.
Welcome back. Well, markets a little bit lower, par for the course after the kind of rally that we have seen, but a few stocks are doing a thing of their own. Jio Financial, that's moved to the high point of the day, and that's really been the big mover in the last couple of months. Reliance has done well, and Jio Financial, the share price derives much of its value from the holding that they have in Reliance Industries. Just take a look at that stock. Jio Financial last few months has outperformed what Reliance as well has done. But let's get in William Sells, Global Chief Investment Officer at HSBC Private Bank, and Premier Wealth, who joins us. Hi, William. Good morning. Thanks a lot for joining in. Well, what a first half of the calendar year it's been, right? We're drawing it, we'll be closing it down today. But you've had tariffs, you've had Trump, as well as you've had geopolitical issues. First, let's focus on Trump. Do you think we have experienced peak Trump in the first 6 months of the year? And in that sense, would it be good for US equity markets for the remainder of this year? Because there was some kind of uncertainty, but do you think US markets are now favorably placed for the second half?
Yes, we think so. We are overweight on US equities because of a number of factors. Firstly, when I talk to clients, and I'm just at the end of a 1-month roadshow here across Asia, and talking to you from Bengaluru, most clients are no longer for a recession nor stagflation, and that's obviously very good news. We ourselves are looking for 1.8% GDP growth in the US and 11% earnings growth in the US, so that's certainly a positive. I think with regard to the unpredictability of policy, what people have also realized is that we actually have two-way risks rather than only just one-way negative kind of risks. We've seen policy sometimes being adjusted when there was too much pressure from the markets or from business leaders, and clearly that's positively interpreted. So that basically explains why the market has rebounded, and we think it can continue to rally.
All right, so we have experienced peak Trump then in the first in the first half of the year, and the very fact that when the markets get a little bit jittery, he steps in. So that should be good times, right?
So yes, I do think that we have that positive momentum here going now, and it also illustrates basically that it is very dangerous to try to time the market. Staying in the market, so what we call time in the market, is important because obviously, as we all know, as Einstein said, compounding is the 8th wonder of the world. To try to be in diversified portfolios, but of course building resilience because we are going to continue to have policy uncertainty, lots of things hitting us, and that certainly will continue over the next 4 years, in my view. So therefore, staying in the market but building resilient portfolios.
All right. I was curious to know about your traffic experience in Bengaluru, because the weather is great. They say that once you enter Bengaluru, first the weather hits you and then the traffic. I hope you did not experience that. Having said that, what about emerging markets? I see you being positive on China, Singapore, as well as India. In that, what would your pecking order be? And how much of an outperformance do you think some of these indices could do versus, say, the global markets, the developed markets, that is?
It's not to try to be diplomatic, but indeed we are overweight both on China and India and then also on Singapore. But they are very different types of markets. Obviously, valuations between India and China are very different, but the ROE is very different as well. Indian companies tend to have very high ROE. The Chinese are working on this and also working on distributing more dividends, being more shareholder friendly, and so on. In China, it is not the entire market that one can buy, I think. It is really, when we talk to our clients and to institutional investors, it's really the technology side that gets the attention, that people are positive about, and you can see, great progress there as well. But still, the domestic demand is still, a factor that needs to be improved on. We are expecting that the Chinese government will deliver more stimulus, but they don't want to do a big bang approach. They don't want to react to every single headline out of the US. They do it in a much more structural fashion. You started to see some improvement in that domestic demand, but clearly the deflationary spiral is still, is still a negative. So you don't see that in India. So when you buy China, I think it needs to be the technology sector and it needs to be those dividend payers. Whereas in India, we like the industrial side, we like the healthcare side, we like the financials as well.
Interesting point out there. But what about the Indian economy? Things seem to be moving in our favor. We have the Reserve Bank of India that's given us that growth booster shot. We have this currency that's fairly stable. And in fact, earnings are likely to pick up in this year as well. With that sort of a backdrop, do you think Indian equities can continue to do well from here on?
I do agree, yeah. So we expect 6.7% GDP growth this year, 6.2% next year. Basically, mostly driven by the consumer, who sees that falling inflation, indeed, that you're pointing out, in part because of the oil prices, the food prices, and so on. Obviously, it's helped by the rate cuts as well. We expect one further, interest rate cut. I've mentioned the sectors that we like. In terms of style, we would very much stick to the large cap companies because you see that the relative valuations are in favor of the large cap. The small cap have rallied potentially a little bit too much from a relative perspective, and the foreigners are going to stick with the large caps.
So you prefer large caps versus mid caps, and in terms of the sectors you liked, you said healthcare. I just missed the industrials, and what else?
And the financials as well.
All right.
In part to get that income as well.
What about the European markets and UK? You've made some changes to your portfolio there as well. So if one had to say make a global portfolio of $100, how would you spread that across US, Europe, and emerging markets? And how much of that would come to India?
Yeah, so I know about the constraints, obviously, that Indian investors sometimes have, having a really globalized portfolio. But if you were to, be able to diversify, obviously, we always recommend that people do that. A lot of our clients have businesses, have lots of stakes here in India or in their home country. And we always try to have them diversify as much as possible because you don't want to double up on the country risk. So, try to diversify globally where that is possible. For the moment, in addition to the countries that I mentioned, India, China, and Singapore, that we're overweight in Asia, we're also overweight in the US, which is, I think, an out of consensus call. More people try to go into Europe, but Europe has rallied already. The proof will be in the pudding as to, how much of that fiscal spending and how much of the structural reforms, even more importantly, they will be able to do in Europe. I think in the US, people have relatively low growth expectations, relatively low earnings expectations. The positioning and the sentiment is relatively weak. So I think the earnings season in the US can be a trigger for companies to do better than expectations and therefore, to support a rally there. So an overweight for us in the US as well.
All right, an overweight on US as well as India, China, as well as Singapore. So that's the view coming in. Thank you so much, William, for joining in and giving us your call on the global equities and doubling down on your preference towards India in the emerging market space as well. As we slip into that short break, just keep an eye out on Siemens. That stock's moved to the high point of trade. A couple of these banks doing well as well. Bank of Baroda for one, and we have Federal Bank, which has spiked as well. And then we do have, Hindustan Copper, which too has moved to the high point of trade. We take a short break, come back on the other side. All right, before we take that short break, we do have PTC Industries, the stock on our radar after its wholly owned subsidiary, Aeroloi, has signed a memorandum of understanding with Safran Aircraft to co-develop aircraft engine components. To talk about this and more, we do have Sachin Agarwal, who's the chairman and managing director of the company, who joins in. Sachin, first up, if you could give us a scope of revenue generation via this MOU. What does this mean? Because you had told post your fourth quarter results that you already have an order coming in from Safran for a few, few aircraft. What does this deal mean in terms of, in addition to what was your deal with Safran earlier? What is the revenue scope here?
Good morning, Mangalam. No, this is a bit different. The previous MOU and long-term agreement that we had signed with Safran Aircraft Engines was related to civil aviation, commercial aviation for LEAP engines. This is specifically related to military engines. So here the scope is quite wide. It's related to all titanium and superalloy and all critical material component manufacturing, as well as material supplies in various forms, right from billets, bars, sheets, plates. So it has a very, very wide scope and has huge implications for India in terms of Make in India, as well as the indigenous content requirements for the new policy that's coming in place. What's the value of this? What's the potential value of this deal? Well, that's a bit difficult to put in right now in terms of value of the deal, because it's right now in the form of an MOU, which will not translate like in the previous MOU that we signed with Safran. The MOU was then later translated into a long-term agreement and contracts. So that stage will come probably in a year or so from now. So then it will be a better point to give some value on this. But it has a huge potential, and it gels in with all the investments that we are currently doing in all these fields.
All right, Sachin, hi, good morning. Good to see you, and thanks a lot for joining in. This is Nigel on this side. So you've given us few details with regard to this is military focused. The MOU is both for materials as well as for casting. And also you mentioned, I think it's going to be a mix of titanium as well as superalloy. Do we have any broad sense about which way it will be tilting towards? And what is the realization difference between the two, superalloy as well as titanium?
So normally in an engine, the weights is about split 50-50 between titanium and superalloys. In components, the valuation for superalloy is about in the region of almost, it ranges from almost like $400-500 a kilo to almost $2,000 a kilo, or even going up to even $10,000 a kilo. So it has a huge range depending on the component. And similarly in titanium, it again in components it goes from almost $500 to about $2,000. In material supplies, it's also similar that in titanium we're talking about somewhere between $40 to $40 per kilo, all the way up to almost $200 per kilo, and on a similar range on the superalloys materials as well. So they're very similar.
Right. This is one of the businesses that you've signed an MOU for. What about your other order book right now? I mean, where does that stand at? What is the visibility that you have? On this one, you said you'll probably get visibility, say, a year from now when it comes to value. As of now, with the orders that you have on hand, what kind of visibility do you have in terms of revenue for the next, this year and the next year?
So we currently have a reasonable amount of orders. We almost booked for, I think we in the region of close to almost having orders in the region of approximately 700 to 800 crores already in. We also expect that this financial year will be almost close to doubling our revenue from the previous financial year. So there is a very good visibility available in that sense. And then again, quite a significant increase the following year as well. So in terms of order book, we are very well placed. We have a substantial amount of capacities that are getting created, which will be unleashed in the financial year of 27. So again, then there will be quite a bit of increase after that as well.
All right. So for this year, we're looking at nearly, I think the last time around we'd spoken about this. This year you should end with in the vicinity of around 750 crores. That's correct, right? In terms of revenues?
Well, close to 700. I said almost double. So from the current financial.
750 crores should be a fair estimate. And margins in mid-20s?
Mid to high 20s.
Mid to high 20s. All right. But the bigger year, as you mentioned last time around, is with capacities coming on stream and with the order book, picking up pace. FY27 appears like the bigger year. So this year you double your revenues, and on that base you more than double your revenues, right? FY27 you should be looking in the vicinity of around 1,700 crores or thereabouts.
No, I think the primary unleashing will happen in the financial year 27-28. Rather than 26-27, the reason being that a lot of qualification work that needs to be done on the new plant. So the plant will be up and running in about a year and a half from now, but the qualification work will start after that. So that will consume the next financial year to a certain extent. But but still from the domestic sources, there will be still quite a bit of an increase.
Sachin, the rate at which your order book is growing, your revenue projections are, and at the same time you have been increasing capacities in titanium. We see that some plasma arc furnace, etc., going under trial production, etc., too. That has put a stretch on your working capital and your balance sheet, because I'm looking at cash flow from operations, and that has been negative for the last many years for a company like yours. So we're just trying to figure out at what point do you turn CFO positive, and what is your working capital outlook, working capital days?
So I think the working capital, I don't know which data you're looking at, but I think we have remained quite reasonably sustained on our operations. So there are two parts of our fund flow. One is related to the funding of the new plant, which is primarily going into investment in the new plant, which is in the tune of almost 800 to 900 crores currently ongoing. But on the operations side, we have remained reasonably well cash surplus, and which is also further getting funded or contributing to the investments that we are making. So the margins in this business, once the new capacities are released, are quite significant, especially in castings and the component business, where the margins, EBITDA margins, exceed 40-50%, especially also on a material side, where it's in excess of 30%. So with those levels of margins, I believe that there is no reason that we will be at any point cash starved in coming years.
All right, Sachin, just want to understand your working capital days. I think the goal is to get to hold it around 100 days. Is that correct?
That's correct.
That's the number you like to maintain. All right. Yeah. And since you have bulk of your expansion that will be coming in FY 26-27 onwards, for FY 29, what kind of a revenue number could you give? What is the aspiration? And since margins will improve from year on, how do you see the number, pan out from there as well? So let's focus on FY 29, since you'll have the capacities fully on stream and you have visibility. Please go ahead.
So 29-30, we are looking at reasonably in excess of 2,500 crores of top line.
Okay.
Probably touching somewhere around 3,000 even in 29-30. So in terms of margin, I think we'd be easily sitting above 30% positively. So quite a reasonably high margin, as well as very massive growth coming.
So roughly 750 to 900 crore EBITDA is what you could potentially do by FY29 is what you're saying, right?
Yeah, almost close to 1,000, yeah.
Yeah, it'll be interesting because
29-30, I said, so not.
Okay, as of now, your market cap is 22,500 crores. So clearly the street is looking ahead and saying that you're going to deliver blockbuster numbers. We'll hold you at this aspiration. Thanks a lot for joining in and giving us some color. Maybe the next time around, you'll be able to quantify this potential that you have from this MOU? Appreciate you speaking to us here on CNBC.
Just before we let you go, would you have a target on return on equity and return on capital employed? Because you are investing so much, these two ratios would be, pressured in the very near term.
But I think the numbers, as I said, 29-30, the numbers already kind of tell you what the kind of returns can be made. We are currently making investments in the region of 800 to 900 crores with potential EBITDA margins of in excess of 800, 900 crores incoming in the next few years. So that would give a very, very high ROE and ROC as well. Besides the agreement that we have just recently signed with Safran.
On ROE and ROCE?
Sorry?
Do you have a target on ROCE and ROE?
No, I don't have a target, but I do see a very high return.
Got that. Take your point.
And besides this agreement that we signed, in the next few months, we are signing many more agreements to come in the next 6 months. So which will keep you informed on that.
All right, take that point. Thank you so much for joining in and giving us your outlook on the business. With that, we'll take a short break, come back on the other side. Manisha Gupta joins in with focus on all things commodities.
सपना था कि खुद का ट्रांसपोर्ट बिजनेस हो और फंडिंग मिलना इतना आसान नहीं था।
मशीनें तो खरीद ली थी, पर बड़ा ऑर्डर लेने के लिए पूंजी की जरूरत थी। घर से ही केक बनाने का काम शुरू किया था मैंने।
किसी के यहाँ टेबल कुर्सी बनाते बनाते मुझे ये हौसला मिला कि मुझे खुद का काम शुरू करना चाहिए।
फिर इनका साथ मिला और नए रास्ते खुल गए।
फिर इनका साथ मिला और मेरा बिजनेस इतना बड़ा हो गया। फिर इनका साथ मिला और फैक्ट्री यहाँ तक पहुँच गई।
फिर इनका साथ मिला और मैं इस मुकाम पर पहुँच गया।
सुन रहे हैं ना, ये सब एक ही नाम की बात कर रहे हैं और वो नाम है पीएनबी। आपका सपना सिर्फ आपका नहीं होता है, वो पूरे देश की तरक्की का हिस्सा होता है। इसीलिए पीएनबी लेकर आया है एमएसएमई लोन स्कीम्स जो छोटे छोटे बिजनेसेस को आगे बढ़ाने के लिए बनाई गई है। इजी डॉक्यूमेंटेशन और अट्रैक्टिव रेट ऑफ इंटरेस्ट पे लोन आपको देता है पीएनबी, वो भी बिना किसी झंझट। झट से पीएनबी का भरोसा, अब हर व्यापार होगा बड़ा।
वेलकम दादा। वाह, अरे भाई ब्रेकफास्ट मिलेगा?
हाँ जी।
हीटर?
हाँ जी।
तो अब क्या सूरज लाओगे?
हाँ जी।
जहाँ सूरज वहाँ रोशनी और जहाँ विक्रम सोलर वहाँ खुशियों वाली सनशाइन।
सेफ इन्वेस्टर्स के लिए, बोल्ड इन्वेस्टर्स के लिए एंजल वन फॉर एवरीवन। 3 करोड़ इंडियंस की तरह आप भी शुरू कीजिए।
Angel One for everyone. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
पैसा लगाना है तो सेंचुरी प्लाई क्लब प्राइम पे लगाओ। डूबेगा नहीं, जलेगा भी नहीं, कोई खा नहीं जाएगा, धोखा नहीं देगा, ऊपर नीचे भी नहीं होगा, सेफ रहेगा, सिक्योर्ड मिनिमम 30 साल का रिटर्न देगा। अब इससे बेटर इन्वेस्टमेंट है तो बताओ। Century Ply Club Prime. Raho befikar.
Pro FX Tech Limited, engaged in retail and distribution of specialized AV products for home theaters, custom theaters and home automation systems, launching its IPO on NSE Emerge platform with a price band of rupees 82 to 87 per equity share. IPO opens on the 26th of June and closes on the 30th of June. Book running lead manager, Hem Securities Limited.
Welcome back. Let's get trades at 10. We have LIC, which is doing well, RBL Bank higher as well, and we are seeing some traction in all the PSU banks this morning so far, even as the frontline indices are slightly contained. Mitesh Thakkar joins in. Mitesh, what would your trade at 10 be?
In fact, Mangalam, I have LIC as a recommendation with a stop at 964 and a target of 1010. And the other one is State Bank of India. It's looking good as well. Buy here with a stop at about 805 and a target of around 840.
All right, LIC and PSU Bank. You have SBI as well as LIC as your pick. Thanks a lot for joining in. With that, let's shift focus to the commodity space. Manisha, what's the one commodity that you're tracking today?
Well, I actually want to take a look at all the commodities for the month of June because it has been quite an interesting month. But yes, I'll put in focus crude oil prices first because this clearly has been the most volatile of all. And it is trading nearly a percentage point lower in the Asian markets right now after nearly 13% of a decline in the previous week for the crude oil prices. Well, a 13% decline has been the sharpest weekly decline that you've seen in 2 years coming for the crude oil prices. One, it is about the Iran-Israel war, as fragile that ceasefire is, but it seems to be holding, and that's taken the premium off the markets. The second thing is that you have to really look at the volume, or rather the volatility that we've seen in crude oil prices. The 12-day Israel-Iran war had the crude oil prices surging all the way up to $80 a barrel, and then we saw correction come down to $67 a barrel, and that's exactly where we seem to be trading at this point in time. The other thing that the street will watch out for is the OPEC Plus meeting. Well, that's on 6th of July, where they decide on what is going to be the production for the month of August now. The expectation is that they will increase it by 411,000 barrels per day, and they have been actually doing this for the month of May and June and July, and could be happening for August as well. This actually would be a fifth monthly increase in production that OPEC could be doing, and that's yet another reason that you have seen prices talk about a supply surplus of almost 1 million barrels per day in this year, and that's weighing onto the markets too. A couple of things which actually could be supportive is one, the China-Iran crude imports, which hit a record high for the month of June, could see more gains coming in the future months as well. The second point is about the US oil and rig count, which also has seen a decline by a fifth straight month this time around. And with that, the actual count of US oil and rig now stands at the lowest since October 2021. So barring these two factors, everything else seems slightly bearish for the crude oil prices from where we stand. But I do want to take you through on what we've done in month of June for many of these commodities. And I'll start with energy, where we are looking at a second monthly gain for the crude oil prices, up by 5%. Natural gas has been the only one that has seen a decline. Otherwise, heating oil, gasoline prices actually have seen gains for the month of June there. Take a look at the precious metal prices there, and here you see a sea of green. Barring gold, where we haven't seen any safe haven buying, the money actually came out of gold and went to various other metals. So silver is gained up by 4% for the month of June, but the actual outperformance comes in from platinum and palladium, 14% up for palladium, 28% of gains coming in for platinum as well. And my final plate will show you the base metal prices, where we have seen the outperformance come in from copper, 4.5% of gains in the month of June. We've seen stronger gains from aluminum at 5%. Actually, metals have seen a good month for the month of June. Barring steel, which also seems to be easing its losses there, we've seen a stronger month there. And the markets do believe that base metals perhaps is the way to get into for the month of July as well, with slightly longish positions there.
All right, base metals is the way to go. Thank you, Manisha, for that. All things commodities. With that, we'll take a short break. On the other side, our special segment, Economy Unpacked. Lata will be in conversation with a battery of people. There will be Samiran Chakraborty of Citi India, Neeraj Gambhir of Axis Bank, Srinivasan Varadarajan, who's a banking veteran, and a market expert on how the bond markets must read the RBI's puzzling moves.
जिंदगी की हर छोटी बड़ी जरूरत के लिए आप जो सपने सजाते हैं, बस उसी उम्मीद को तो हम सहारा लगाते हैं। SIP आपकी सेविंग्स को आपकी खातिर काम पर लगाएगी। आज ही अपनी पहली SIP की शुरुआत करें। अधिक जानकारी के लिए अपने वित्तीय सलाहकार से परामर्श करें। LIC म्यूचुअल फंड द्वारा निवेशक शिक्षा की एक पहल।
म्यूचुअल फंड निवेश बाजार के जोखिम के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।
आपका और हमारा बहुत ही लंबा और करीबी रिश्ता है। हम उस चटकारे में हैं जो आप अपने दोस्तों के साथ लेते हैं, उस दराज में है जिसमें छिपा है माँ के राजमा चावल का राज। कभी आपके हाथ में अच्छाई की चमक बनकर आपका दिल जीतते रहे। तो अगली बार आपको कोई चीज पसंद आ जाए तो उसे पलट के देखिएगा, जरूर हमारा नाम दिख जाएगा।
कब तक इसी स्क्रीन पे लगे रहेंगे? खुद के लिए टाइम निकालें, कैंसर स्क्रीनिंग करें। याद रखें, स्क्रीन करें। संजीवनी, यूनाइटेड अगेंस्ट कैंसर।
कैंट आरओ देता है सबसे प्योर पानी, और कैंट आरओ प्योरिटी दिखाता भी है। खुद ही देख लीजिए। कैंट का सबसे शुद्ध पानी पियो और हेल्दी रहो।
क्या आपको पता है VIP शादी.com पे पहला कंसल्टेशन बिल्कुल फ्री है।
क्या आपको यह भी पता है कि यहाँ मैच मेकिंग होगी 5 गुना ज्यादा सक्सेसफुल? रजिस्टर नाउ।
इक्विटी में इन्वेस्ट कर, ग्रोथ का है चांस। डेट में है लो रिस्क, बात मेरी मान।
गोल्ड सिर्फ गोल्ड, भैया ने भी यही किया।
सुन सबकी, कर मल्टी, मतलब मल्टी एसेट एलोकेशन फंड, यानी 3-in-1 फंड। ये इक्विटी, डेट, गोल्ड तीनों में एक साथ इन्वेस्ट करें। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेज ध्यान पूर्वक पढ़ें।
Economy Unpacked is a new series from us to understand difficult questions about the economy. In this first edition, we are trying to answer some key confusions on interest rates emanating from Reserve Bank's actions. Confusion number one, Reserve Bank cut interest rates by 50 basis points on June 6th, but said it was moving stance to neutral from accommodative. Bond yields, which should have fallen after the massive rate cut, actually ended up rising because market concluded no more rate cuts. However, the 2.8% May inflation has rekindled hopes of another rate cut. Now, confusion number two. Will Reserve Bank keep liquidity just enough so that the overnight call rate comes towards the repo rate of 5.5%? Or will call rate remain at 5.25%? Now, immediately after the policy, yields rose and then they fell below 5.25%. In fact, they went to 5% mark because Governor said that rate cut transmission is still in early stages. So, market concluded liquidity will remain surplus. But last week on June 24th, Reserve Bank announced a massive 7-day VRRR, variable rate reverse repo of 1 trillion rupees, which means Reserve Bank is absorbing 1 trillion of liquidity. So, yields rose. Market is still confused. If Reserve Bank will continue to do VRRRs and hence absorb liquidity, push up the call rate to 5.5%, or will it do VRRR only when liquidity gets too plentiful? Now, for all these questions, I'm joined by an elite panel of experts. Samiran Chakrabarti, Chief Economist, Citi India; Neeraj Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank; Srinivasan Varadarajan, Banking Veteran and Market Expert. Before I shoot my first question, for those of you who are equity expert viewers, just 2 or 3 terms. One, when we say VRRR, variable rate reverse repo, the RBI is pulling money out of the system for a temporary period. Overnight call rate is the market where banks borrow from one another for 1 day, and the TREPS market is where mutual funds, insurance companies, banks, all of them borrow from one another for 1 day. We will use these jargon, but let me get to the expert. First, Neeraj, what did you make of this VRRR? Are you getting a feeling that Reserve Bank is now going to bring the call rate to 5.5%?
I think that looks like to be the case. To me, it feels like that after announcing the change in stance to neutral from accommodative, Reserve Bank is not very comfortable with call money rates trading significantly below the repo rate. And I think this introduction of the 7-day VRRR, and market is sensing that there could potentially be an extension to overnight VRRRs, which means basically RBI taking out money from the system at repo rate will basically fix the floor of rates at repo rate. It was about 25 basis points lower. Now it's going to be closer to the repo rate. What this basically means is that if the overnight gets fixed at repo rate, which is 5.5%, all the other rates in the money market, whether it's T-bill yields or whether it is CP/CD rates, will get indexed to this rate, and therefore, in some senses, there is going to be a little bit of upward bias towards these money market rates as a result of this action. We will.
Yeah, go ahead.
No, I'm just saying that this is something which is a bit of a change in their operating procedure of monetary policy post the recent MPC meeting. And I think it is more of an alignment of their operating procedures and operations in line with the change in the stance from accommodative to neutral.
Now, I'll tell you, the governor was very clear, not this policy, but in previous policies, that when they change the stance, they are not referring to liquidity. They are referring to their view of repo rate. I remember them, I'm not quoting verbatim, but I remember them saying that. But Samiran, what are your thoughts? Is it not possible that the RBI and the governor were alarmed that call rate went even below 5.25%? And I think at one point there was one trade even below 5%. And TREPS market, there the rates went really towards 5% and below 5%. So they're only correcting this distortion, but they don't want the call rate to come from 5.25 to 5.5? Is that one way of looking at it?
So I will agree with Neeraj on this, that it appears that this is in sync with the RBI's change of monetary policy stance from accommodative to neutral. Till the monetary policy stance was accommodative, RBI was allowing the overnight rates to be closer to the reverse repo rate rather than the repo rate. Now, since the stance has changed, the sanctity of the monetary policy framework needs to be preserved, because as of now, in the inflation targeting framework, the operating procedure of monetary policy is to keep the weighted average call rate close to the repo rate under usual circumstances. So because the market is right now, in my view, in a pretty much normal situation, for RBI to have this sort of abnormal thing of having the overnight rate much lower than the repo rate probably wouldn't have made sense. But at the same time, I don't think it has any signal for future rate action. They can still go in for rate cuts in the future, and through that bring down the overnight rate. That's probably a cleaner way of doing this rather than having this sort of stealth method of a rate cut.
Okay, Srini, I just want to present to you, and you would have heard this, of course, what the governor said in the Business Standard interview. He said, keeping liquidity surplus helps rate cut transmission. RBI will continue to weigh the trade-off between keeping call rate at SDF rate for better transmission or at repo as the framework requires. Broadly, those were his words. You would know much better about transmission. Has transmission really taken off? If the governor and the RBI want transmission, will they push up the yield from 5.25 to 5.5?
Transmission. Is transmission something to do with lending rates, or transmission something to do with the deposit rates? And clearly, I think, and the way I look at how the policy and the rate cuts have sort of happened over the last few months, it looks like, I think, the RBI would like immediate transmission or transmission to happen as quickly as possible. And that they are trying to do it through rate cuts, because the EBLR immediately sort of resets. And I think that is forcing the transmission on the lending side to make sure that if there is a facilitative environment which can be created for credit growth and therefore trigger some amount of activity in the economy, let us facilitate that. So that to some extent is one aspect of transmission, because the fact that transmission through cost of deposits coming down is a process which is taking longer. And in my view, the way the market structure is today, that is unlikely to happen, because there are always going to be banks which are going to be borrowing at high rates. And what CDs and bulk deposits coming down is not reflective of the liability profile of banks, because these are the two products which the regulator doesn't want banks to rely on. They want banks to rely on our retail term deposits and CASA. That to some extent is not changing much with any of the rate cuts, and it's only liquidity to some extent which is sort of impacting that. So I think there is a basic issue is what is the policy rate seeking to achieve? Is it seeking to achieve lower lending rates, which is what I think RBI has now come down to, saying that, okay, if I cut rates, I will push the EBLR lower, and then the banks will have to then manage their own liquidity and profitability. And then that's why we've seen banks sort of look at savings rate to immediately reduce their cost of funds. So to me, it looks like we have to relook at what the policy rate is supposed to do, because if the repo rate right now impacts only T-bills and to some extent GSEC, and long-term GSEC also, it is getting slow. The cost of funds of banks and the policy rate, I think are right now, the sensitivity is becoming lower and lower. I think lower.
1 minute, Srini, 1 minute. In the past, RBI has told me and bankers have told me that, when there is plentiful liquidity, you're actually putting money in SDF, we are bolder to reduce deposit rates. When we are kind of depending on the call rate to borrow, at that time, we are not in a mood to reduce deposit rates. So the Reserve Bank does make a connect that Lending rates, of course, are linked to EBLR. You know, banks are hamstrung. And the Reserve Bank's psyche, at least in the past, I didn't speak to this governor, in the past is bankers are in a better mood to cut deposit rates when there is plentiful liquidity. Do you buy that? And if you buy that, that means they will be keeping liquidity plentiful?
You would have to look at the average cost of retail term deposits for this quarter and the coming quarters. I would suspect that it is going to be not more than 50% of the extent of rate cuts. And I think that is primarily because there are high rate borrowing banks which will continue to do at those rates. They are not getting rates lower. Only the banks which have to some extent a large depositor base and which have clearly sticky customers are in a position to do it. So therefore, if you look at the system level retail term deposits, I don't think so the transmission is going to be so easy because the power equations of different banks are different. And I think the consolidation of market shares among different banks is happening at such a pace that I think the people who are left out are never going to be able to lower their deposit rates.
So your short point is he will bring the VRR to the call rate to repo rate?
Now, basically what I'm saying is RBI is forcing banks to lower their lending rates through the repo rate cut by the EBLR mechanism.
Okay. And
then it's up to the banks to manage their liquidity profile in terms of what they want to lower, how they want to lower, and try and manage their NIMs, margins, and profitability.
All right. Okay. Neeraj, what is your sense about, therefore, another rate cut? If the RBI is already bringing the call rate to the repo rate, then does that reduce are they giving an indication that there isn't scope for rate cut?
So before I come to another rate cut, let me just respond to this question of transmission. In my opinion, and it's a little different from what Srini said, this quarter and this cycle of rate cuts, we've seen one of the fastest transmissions on the liability side that I've ever seen in the banking system. We've already seen large banks cut their savings bank rate by approximately more than 50 basis points. We've seen a significant reduction in term deposit rates for retail. I'm not talking about the bulk or the CD rates. I think bulk and CD rates have actually come down by almost 130 basis points since their high in the March. So I would, I'm basically, my conclusion is that given the change in the structure of banks' balance sheets since 2019, where more than 50% of assets are now linked to EBLR, banks are being forced to relook at their liability pricing far more proactively and far more quickly than I have seen in the past. And obviously, Reserve Bank's massive liquidity injection that they have done over the last 4 months or 5 months has actually helped in the process. I think the fact that Reserve Bank kept the call money rate close to STF rate or lower end of the corridor has actually helped banks do significant repricing. Now, it's the structure of the balance sheet that the liabilities reprice at a slower pace as compared to the asset. The asset repricing is almost instantaneous. It happens within a quarter. The liabilities take time to reprice from a stock perspective. But from an incremental perspective, I think banks have taken a lot of action in terms of bringing down their retail deposit rates. Obviously, I'm talking about large banks, not the entire banking system. As far as the future rate cuts are concerned, I don't think that this action of normalizing the call rate to repo rate is any indication of what Reserve Bank may end up in the future. I think the door is still open for further rate cuts, provided we see inflation continuing to come down and there is some weakness in the growth. But I think the bar is a little bit higher in my opinion.
Samiran, I have to take a break, but I want a quick reply. Do you think if you're in the Reserve Bank's shoes, you will be satisfied with this level of transmission? I mean, credit growth is really abysmal.
So there is a bank lending channel of transmission and there is a bond market channel of transmission. The governor in his interview has clearly mentioned that both are equally important. I think definitely the bank lending channel is working fine. Whether the bond market channel is working fine or not, how much patience RBI can show on that, that's something that we have to see.
Okay, fair enough. I have to take a quick break, but I'm going to ask now even for the CRR views and how the Reserve Bank will approach it in the future as well on rate cut transmission. The entire conversation is going into CNBC Access. So viewers, you can catch the full conversation of Economy Unpacked post-market hours on CNBC Access. After a break, Chartbusters for you.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, 7 दशक देश के साथ.
कैश कम है, विड्रॉ करना पड़ेगा.
ट्राई SBI डोरस्टेप बैंकिंग. कन्वीनियंट है.
बैंक आएगा, करेगा कैश डिलीवर. टिक. TDS सर्टिफिकेट. टिक टिक. अकाउंट स्टेटमेंट. टिक टिक टिक. हैट्रिक. सबको पता है.
SBI डोरस्टेप बैंकिंग कन्वीनियंट है. सबको पता है.
CNBC-TV18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC-TV18 Market Central.
Providing sharp market intelligence for wealth creation with a commitment to doing it right.
The world's largest accounting body, the Institute of Chartered Accountants of India, ICAI proudly celebrates 77 years of trust, transparency,